In the last 48 hours of one late December trading window, silver dropped in a way that didn't match the story people were telling about it. Reports tied the move to a margin change on a major U.S. futures venue. Initial margin on a key silver contract shifting from roughly $22,000 to about $25,000 per contract. That's not a headline most people read. But in leveraged markets, that single line can act like a trapdoor. When the cost to hold a position rises fast, the market doesn't negotiate. It liquidates. And here's the number that breaks normal expectations. In 2024, the world installed more than 600 gigawatts of new solar power. Not 600 gigawatts total, 600 gigawatts added in a single year. That is an energy build-out measured in industrial revolutions, compressed into 12 months. And it's happening while industrial silver demand has already printed a record, 680.5 million ounces in 2024. They said the silver market was too deep for any one industry to matter. They said it was a monetary metal, a jewelry metal, a byproduct metal, a metal that would always be there. They said solar could scale without changing the supply equation. But the math under those statements is changing faster than the narratives can keep up. Because the strange thing is this: the most disruptive moves in silver often happen when price looks weak, not when price looks strong. The public sees a red candle and assumes the story is over. Institutions see a red candle and ask a different question. Did the market just relieve paper pressure, while the physical constraint stayed exactly the same? And that's where this gets interesting. The market can be knocked down in hours. Solar build-out can't be rolled back in hours. Industrial redesign can't be rolled back in hours. In the short run, leverage and rules can change the price. In the long run, only metal in the right place at the right time satisfies demand. What I'm about to reveal changes the frame. This isn't a silver is undervalued argument. This is an infrastructure argument. It's about a demand engine that is becoming price insensitive at the margin and a supply system that cannot expand on command. It's about the gap between what the price says and what the system needs. And it's about who already understands that gap. Welcome to Macro Ledger, where we decode what matters before it becomes headlines. If you're the kind of person who wants the mechanics, not the slogans, you're in the right place. Subscribe if you want calm, data-first breakdowns that keep you ahead of the noise. And drop a comment with where you're watching from, because the silver story looks different, depending on whether you're seeing it from a manufacturing hub, a mining region, or a financial center. So let's reconstruct what happened and why it matters. In late December 2025, reports described a sharp move lower in silver prices, alongside a margin increase on a major futures exchange. Margin is not a punishment, it's a control knob. The exchange raises it when volatility rises, or when it wants to reduce risk in the clearing system. But for traders using leverage, it has the same effect as suddenly raising rent on a building you're already living in. If you can't pay, you leave. And when many traders have to leave at the same time, the selling becomes the story. In normal market behavior, price is supposed to reflect supply and demand. In real market behavior, price often reflects forced behavior first and fundamentals later. A margin hike can create forced selling even if the underlying physical demand is stable or rising. That's the contradiction at the center of this episode. The paper mechanism can slam price, while the real economy mechanism keeps pulling metal. Now zoom out from the candle and look at the engine. Solar is not just growing, it's scaling. A year with more than 600 gigawatts of new solar installations implies an industry that is no longer experimenting. It's industrializing at full speed. And even with ongoing efforts to reduce the silver content per panel, photovoltaic manufacturing remains one of the clearest, most direct industrial demand channels for silver, because silver's conductivity and reliability are hard to replicate at scale without trade-offs. At the same time, the broader industrial base is consuming silver for electronics, chemical applications, medical uses, and newer energy systems. Industrial demand hitting 680.5 million ounces in a single year is not a rounding error. It's a structural signal. It tells you that silver is behaving less like a collectible and more like a component. So why doesn't the price simply reflect that? Because silver is traded through layers. There's the physical layer, where factories need metal. There's the inventory layer, where vaults report tonnage. There's the financial layer, where futures and options set the marginal price. And there is the narrative layer, where everyone tries to simplify a complex system into a one-line explanation. This is the part no one is discussing. The system can show plenty of silver in aggregate, while still being tight in the specific forms, locations, and delivery timelines that industry requires. A vault number can look enormous, and the usable float can be constrained. A futures price can look calm, and the procurement desks can look nervous. Those realities can coexist, and when they do, markets tend to reprice suddenly, not gradually. To see why, you have to look at history. Not because history repeats perfectly, but because markets repeat behavior. When a commodity sits at the intersection of finance and industry, the same stresses show up again and again Leverage, inventory visibility, and sudden rule changes that force the price to move before fundamentals have time to be acknowledged. In 1980, silver became a symbol of what happens when speculation and tightness collide. The details are debated, but the pattern is clear. When concentrated positioning meets a market that can't instantly produce supply, price moves fast, then rules change, then price moves again. The point isn't nostalgia. The point is that the system's response to stress is often administrative before it is fundamental. In 2011, silver again showed how quickly sentiment can flip. Prices surged, enthusiasm peaked, and then margin requirements rose repeatedly across futures venues. The effect was predictable. Leveraged positions were forced to reduce, volatility spiked, and price fell sharply. The underlying industrial role of silver didn't vanish in a week. The paper positioning did. And in the current cycle, the ingredients rhyme. A rapidly expanding industrial demand channel exists. A financial market sets the marginal price through leverage. And the moment volatility threatens the clearing system, the control knobs get turned. Margin hikes are the modern version of tightening the pressure valve. But here's the crucial difference that makes this cycle potentially more consequential than those prior episodes. In 1980 and 2011, demand was heavily driven by investment fervor and macro sentiment. Today, a growing portion of demand is structural, tied to infrastructure build-outs and manufacturing commitments that don't pause just because a chart looks ugly. Solar installations don't stop because silver had a bad week. Panel factories don't pause because the future's curve changed shape. Procurement contracts don't get rewritten overnight. That's why the supply math language matters. When demand is contractual and physical, the market's ability to use paper mechanisms to delay repricing becomes limited. Now let's talk about the players, because this is not a story about anonymous forces. It's a story about institutions doing what institutions always do: managing risk, securing supply, and shifting exposure quietly, long before a retail narrative catches up. Start with the exchanges and clearinghouses. Their job is not to predict the future. Their job is to keep the system solvent. When volatility rises, they raise margin. When margin rises, leverage falls. When leverage falls, price can drop quickly. This doesn't require any grand theory. It requires only an understanding of how forced deleveraging works. Next, consider the manufacturing side. Major photovoltaic producers have been working to reduce silver usage per cell through technology shifts, new pastes, thinner lines, and alternative metallization approaches. The key point is not whether they succeed. The key point is what their urgency signals. Companies do not redesign core manufacturing processes unless a constraint is real or expected. Thrifting is not a hobby, it's a reaction. Then there are the physical market institutions, refiners, bullion banks, logistics firms, and vault operators. They sit between the mines and the factories. They make the market liquid, and they manage inventories. Their incentives are to keep metal moving, to earn spreads, and to avoid being caught short during a squeeze in deliverable supply. And finally, there are the policy and standards bodies that shape demand indirectly. When governments set deployment targets, subsidies, and grid integration rules, they influence the slope of solar installation curves. When a deployment curve steepens, material demand is pulled forward. The metal doesn't care why demand rose. It only feels the draw. So what does institutional positioning look like in a story like this? It looks like a change in margin that forces leverage out at a convenient moment. It looks like long-term supply agreements between manufacturers and refiners. It looks like inventory strategies that prioritize certain bars, certain locations, certain delivery schedules. It looks like engineering decisions that reduce dependence on a single input. Here's where timing matters. When you see a spike in volatility followed by a margin change, you are seeing a system protect itself, but you may also be seeing a transfer. Forced selling tends to move positions from weak hands to strong hands. If the underlying physical story is tightening, the weak hands are the ones who can't fund volatility. The strong hands are the ones who can. Now, let's address the biggest dislocation, the way plenty and tight can exist at the same time. On one side, you have inventory reports that sound massive. London Vault data has shown silver holdings in the tens of thousands of tons, with end-of-month totals that can look reassuring to anyone who isn't familiar with how inventory actually functions. The headline number suggests abundance. On the other side, you have behavior that suggests sensitivity. Sharp price moves around leverage, constraints, intensified efforts to thrift silver in manufacturing, and periodic episodes where physical premiums and delivery timelines hint that the market is not as loose as the headline inventories imply. This is a classic commodity issue. Not all inventory is for sale. Not all inventory is in the right form. Not all inventory is in the right place. Not all inventory is unencumbered. Some is held for strategic reasons. Some is already allocated. Some is backing financial products. Some is sitting in a location where moving it is expensive, slow, or contractually complicated. Think of it like a city with thousands of apartments. The city can still have a housing shortage if most of those apartments are not available at the price or terms renters need. Inventory counts alone don't tell you availability. Availability is a function of ownership, willingness to sell, and friction. Now add solar to the picture. Solar demand is unusual because it is broad, distributed, and policy supported. When a country commits to gigawatts, it creates a chain of procurement commitments. That chain filters down to inputs. When hundreds of gigawatts are installed in a year, the chain becomes a river, and silver is not mined like a product you can just decide to make more of. Much of silver supply comes as a byproduct of mining other metals. That means silver supply is often a passenger on other commodity cycles. Even if silver prices rise, production doesn't necessarily surge immediately because the primary decision makers are responding to copper, lead, zinc, or gold economics. This is the mechanism that makes the supply math so stubborn. A price signal can be loud and still fail to create immediate new supply. That's not ideology, it's geology and capital budgeting. So let's bring in the evidence and numbers and connect it to the dislocation. Industrial silver demand hitting 680.5 million ounces in 2024 is one anchor. Solar installations exceeding 600 gigawatts of new capacity in 2024 is another anchor. Those are not small figures. They reflect a world that is building hardware at a scale that absorbs materials. Then there's the margin event, a reminder that the price you see is often set at the margin by leveraged flows, a move from roughly $22,000 to $25,000 in required collateral. Per contract might not sound like much in a world of trillions, but for a leveraged participant, it can be the difference between holding and liquidating. When a lot of participants face that difference at the same time, the market experiences an artificial rush of selling that is disconnected from immediate physical demand. So what does this actually mean? It means the silver market is living with two clocks. The financial clock ticks in seconds. The industrial clock ticks in quarters and years. When a margin change happens, the financial clock dominates. When factories sign supply agreements and governments push deployment, the industrial clock dominates. The price is what happens when those clocks collide. Historically, when a commodity develops sustained industrial pull while remaining financially traded, it tends to go through phases. Phase 1 is disbelief. The market assumes substitution or efficiency will solve it. Phase 2 is volatility. Every tightening episode is explained away as speculative. Phase 3 is repricing. The market begins to treat the commodity as constrained and strategic, not just tradable. The question isn't whether silver can be thrifted in solar. It can. The question is whether thrifting outpaces deployment. If solar keeps scaling, the absolute demand for silver can rise even as silver per unit falls. That's the trick that confuses people. Efficiency can improve and total consumption can still climb. Now let's simplify the mechanism of how a sudden sell-off can happen in a market with rising structural demand using an analogy that makes the plumbing obvious. Imagine a bridge that carries two kinds of traffic, commuters and freight trucks. The commuters represent financial flows. They can turn around quickly. The freight trucks represent physical demand. They can't turn around quickly because they're delivering real goods. Now imagine the bridge authority raises the toll sharply because the bridge is swaying in high winds. The commuters decide it's not worth it, and many turn back at once. From a helicopter view, traffic collapses. But the freight trucks still need to cross because they're delivering supplies that keep the city running. That's a margin hike. It reduces commuter traffic. It can make the bridge look empty. But the freight demand doesn't disappear. The only question is whether the freight trucks get delayed, rerouted, or forced to pay a higher effective cost later. In commodity markets, that higher effective cost often shows up as premiums, longer lead times, and eventually a higher price that reflects the difficulty of sourcing metal when it's needed. But that adjustment doesn't always happen in the price first. It happens in the supply chain first. Now you might be wondering, if this is so clear, why isn't everyone talking about it? Because narratives are anchored to price, and price is anchored to paper. The public watches the screen. Institutions watch the flow of metal and the stability of the system. If the stress is showing up in manufacturing redesign and policy-driven deployment curves and in the need for exchanges to tighten leverage, institutions interpret that as a signal, not a coincidence. So let's talk forward analysis without turning this into prophecy. Historically, when structural demand rises and supply is slow to respond, three broad scenarios tend to emerge. In a conservative scenario, substitution and thrifting reduce the per-unit silver requirement in solar, and recycling grows, partially offsetting new demand. In that world, the system still experiences periodic tightness, but it's managed through efficiency and inventory drawdowns. Volatility remains, but repricing is slower. In a moderate scenario, thrifting continues, but deployment accelerates faster, and the absolute demand for silver remains elevated. In that world, the market sees recurring dislocations. Paper-driven sell-offs followed by physical tightness signals. Watch for persistent strength in industrial demand data, announcements of new solar capacity buildouts, and any repeated episodes of margin tightening during volatility. In an aggressive scenario, the deployment curve remains steep, and supply constraints become more visible in procurement terms: longer delivery times, higher premiums for specific forms of silver, and intensified efforts to secure long-term supply. In that world, the market's paper layer can still create sharp drops, but each drop becomes an opportunity for industrial consumers to lock in supply, gradually tightening the system further. None of these scenarios requires a dramatic story. They require only continuation of trends that are already visible: solar scaling, industrial demand printing records, and supply that can't instantly expand. The key indicators to watch are not flashy, they are boring, which is why they matter. Watch annual solar installation totals, watch industrial demand figures, watch whether manufacturers accelerate silver thrifting announcements, watch whether exchanges continue to use margin as a volatility control in silver, and watch whether inventory headlines align with real-world availability signals like premiums and delivery timing. Now we arrive at the divide. There are people who treat markets as entertainment. They watch price, they react to headlines, and they assume the story is whatever the screen says it is today. Then there are people who treat markets as systems. They watch constraints, they watch policy-driven build-outs, they watch how institutions manage risk, and they understand that the screen can lie for longer than most people can stay patient. This divide isn't about intelligence, it's about attention. The wealth gap in markets is often an information gap. Institutions move first because they have to. They manage supply chains, they manage risk. They have mandates. Retail moves last because retail is trained to respond to price, not to mechanism. And when a structural demand engine like solar starts pulling on a metal like silver, the people who understand the mechanism don't need a dramatic moment to pay attention. They watch the data, they watch the behavior, they watch the contradictions, because the contradiction is the signal. A market can show large inventories and still be tight. A market can have falling prices and rising structural demand. A market can experience sharp sell-offs triggered by leverage controls, while the physical pull intensifies underneath. Those things can be true at the same time. And when they are, the supply math doesn't politely resolve itself. It forces a reset. Futures markets can represent enormous quantities of silver through contracts that are rolled, netted, or closed without delivery. That paper liquidity is useful, but it can also mask tightness because most participants never intend to take bars. Deliverable availability is the small fraction of supply that can actually be mobilized, assayed, transported, and delivered on schedule. When that fraction tightens, the system can look calm in one data set and stressed in another. That's why episodes of sudden downside moves don't disprove tightness. They often test it. If price drops and physical premiums or procurement urgency do not relax, the system is telling you the drop was about leverage, not metal. If price drops and manufacturers accelerate thrifting or start talking more openly about metallization changes, the system is telling you silver remains strategically important. If price drops and exchanges respond by tightening rules again, the system is telling you the market is more fragile than it appears. And if you want a simple way to think about it, think about a grocery store during a storm forecast. The warehouse might show plenty of inventory on paper. The store might even look full at noon, but if 1,000 people decide they need the same few items tonight, the shelf is what matters, not the warehouse report. In silver, solar is that 1,000 people except its nations, utilities, and factories acting through policy targets and purchase orders. And once a supply chain starts behaving that way, the repricing moment rarely announces itself politely. It arrives through friction, delay, and finally a price that catches up suddenly. This is macro ledger, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, you know what to do. And remember, the question isn't whether the system eventually reflects constraints. Historically, it always does. The question is whether you recognize the constraint before the screen is forced to admit it.